Insurance rates are taking a nosedive. Just last week, the Florida insurance market officially flipped. Governor DeSantis stood at the podium in Davie and announced for the first time in a decade, citizens' property insurance rates are going down, an average of 8.7%. If you've been stuck with your carrier for the last 3 years, bleeding money on premiums you couldn't escape, this feels like the moment you've been waiting for. The carriers that abandoned the state, they're coming back. 17 new insurers have come into the market. And according to the Florida Office of Insurance Regulation, 83 different rate filings for price decreases have already hit the regulator's desk. They want your business again. But here's what nobody is telling you in these press conferences. There's 3 specific traps hidden in the new market that can turn a $400 savings into a $1,000 loss. Today, I'm not just reading the headlines, I'm showing you the fine print. If you pick up the phone today to cancel your policy because you saw a cheaper rate, you might trigger a hidden penalty called the short rate. That wipes out your savings instantly. And if you get a letter in the mail from Citizens this week, don't throw it away. That letter could force you into a more expensive policy, whether you want to switch or not. And stick around because in the second half of this video, I'm going to show you how to stop playing defense and go on the offense. I'm giving you my rate optimization checklist. 3 specific changes you can make to your home that can lower your premiums today and make your home more valuable in the future. Let's get into the numbers. First, let's look at the scoreboard. The headline is Citizens. The governor announced an 8.7% statewide drop. But if you live in Miami-Dade or Broward, that tri-county area that used to be the lawsuit capital of the world, you're seeing almost double that. Some of you will see 14% drops. That's real money back in your pocket. But the bigger story is the private market. According to OIR filings, companies like Patriot Select are filing for 11.3% drops. Florida Peninsula is down over 8%. Security First and Universal are all cutting rates. Why is this happening now? It's not charity. It's just math. You've heard the stat. Florida had 8% of the claims, but 80% of the lawsuits. Well, that is finally changing. First, the state killed the assignment of benefits scams. The days of a roofer suing your insurance company for $50,000 over a $5,000 leak are over. Second, we had a mild hurricane season in 2024. Carriers actually made a profit. Third, reinsurance costs dropped. The insurance for the insurance companies got cheaper. So the gap between cheap citizens and the expensive private market is closing. You finally have choices, but choices do come with complexity. Here's the first place you're going to get tripped up. You see that Patriot Select is $300 cheaper than your current policy. You think, I'll cancel today and switch. In insurance, there are 2 ways to get your money back when you cancel mid-year: pro rata and short rate. If the insurance company cancels you, they have to give you a pro rata refund. That means if you used 50% of the policy time, you get exactly 50% of your money back. That's pretty fair. But in Florida, if you cancel the policy midterm, meaning before your renewal date, the insurance company is legally allowed to use a short rate cancellation table. That's a penalty. They keep a percentage of your unearned premium to cover their administrative costs. Here's the math that ruins your day. Let's say you have 6 months left on a $4,000 policy. That is $2,000 of unearned money you expect back. But they hit you with a short rate. They might keep 10% of that remaining balance. That's $200 gone. If your new policy only saves you $150, congratulations, you just paid $50 for the privilege of filling out some paperwork. The strategy is simple. Shop now, lock in the new rate, but set the effective date for the exact day your old policy expires. This is called non-renewing. There's no penalty for non-renewing. Only switch midterm if the savings are substantial. I'm talking 15% or more. Now, losing $200 on a cancellation fee is pretty annoying, but getting kicked off your insurance against your will, that's happening right now to thousands of people. And many don't even realize it until their mortgage payment goes up. Citizens was never meant to be permanent. It's the state's backup plan, the insurer of last resort. So when private carriers come back, the state actively pushes you towards them. And here's the thing, they can legally block you from renewing your Citizens policy, even if the private option is more expensive. I want to know if this has happened to you. Have you received a letter that looked like junk mail, only to find out it was a depopulation notice? Did you get booted off of Citizens? Leave a comment below. Tell me your story. I'm reading all of them because we need to document what is actually happening on the ground, not just what they say in the press conferences. Now, let's talk about that letter. The state wants Citizens property insurance to shrink. It's too big. So they created the 20% rule. Here's how it works for most homeowners. If a private insurance carrier like Slide or Florida Peninsula offers to insure your house and their price is within 20% of the Citizens renewal price, you are ineligible for Citizens. Let's look at some math. Say your Citizens renewal is $3,000. A private company offers you a policy for $3,500. Now, $3,500 is exactly 16.7% higher than $3,000. That is under the 20% threshold. The result? You must take the $3,500 policy. You cannot stay with Citizens. You just got a forced $500 rate hike. Now, there are some exceptions and an appeal process, but for most homeowners, this is how it works. And here's the kicker. If you don't respond to that letter, if you throw it away thinking it's spam, you're automatically switched to the private carrier. You wake up one day and your mortgage company is paying a higher rate to a company you've never heard of. This brings me to the teaser rate risk. Some of these new carriers are offering rates that are strictly designed to be just under that 20% threshold to pull you away from Citizens. They get you in the door in 2026, and then in 2027, they jack up your rate 30%. Once you're out of Citizens, you can't go back unless private rate gets insanely high. You're stuck in the Wild West of the private market. Before we get into the optimization strategies, let's talk about how to tell if your carrier is actually stable or just cheap. You will see a lot of carriers advertising low rates, but the cheapest rate isn't always the best deal. Here's what to look for. First, look at the rating agency. Most Florida carriers are rated by Demotech. It's the industry standard, and honestly, it's relatively easy to get a good rating from them. Weiss safety ratings are much tougher. They're the ones that actually predict financial trouble before it happens. If a company has a great Demotech rating, but a terrible Weiss rating, that's a red flag. Second, look at claim denial rates. Some carriers approve 95% of claims. Others deny 40%. If a storm hits, you want to know who actually pays out. That data is public. We just don't talk about it enough. Third, look at years in the Florida market. A carrier that's been in Florida for 20 years and survived multiple hurricane seasons, that is different than a startup that's only been here 18 months. I'm going to give you a full breakdown of the major carriers in the report card I mentioned at the end. But just know, if a rate seems too good to be true, dig deeper before you sign. Okay, enough about the traps. Let's talk about how you can take control. If you're tired of waiting for the governor to lower your rates, here are 3 things you can do to force your premiums down yourself. Optimization number 1, the 5-year expiration date. Most people don't know this, but your wind mitigation inspection expires. In Florida, this inspection is the golden ticket. It proves your roof is nailed down properly and your trusses are strapped. It can save you 40% or more on the wind portion of your premium. The catch is that it's only valid for 5 years. If you had an inspection done in 2020 and it expired in 2025, when your policy renews this year, the insurance company's computer will automatically remove those discounts. Your rate could jump $1,000 overnight. Not because rates went up, but because your paperwork expired. The fix is simple. Check the date on your WinMit form. If it is 5 years old, pay the $150 to get a new one. It pays for itself instantly. Optimization number 2, the plumbing investment. If your home was built between the late 70s and the mid 90s, go look under your sink. If you see gray pipes, you likely have polybutylene. Insurers hate these pipes. They burst from the inside out. Most preferred carriers, the ones that are offering the low rates, they will deny you outright or hit you with a massive surcharge if you have poly pipes. You're forced onto expensive substandard policies. The insider tip here is that you're going to have to replace these pipes when you sell the house anyway. No buyer in 2026 will touch a house with poly pipes without a massive price reduction. A whole home repipe to PEX costs about $6,000 to $15,000, depending on the size of your home. If you do it now, you unlock the cheap insurance rates immediately. You save money every month, and you increase the resale value of your home. Don't wait until listing day. Get the savings now. Optimization number 3, the roof age sweet spot. Finally, the roof. In Florida, a shingle roof over 15 years old is a liability. You're paying a surcharge just for having it. If your roof is approaching that age, do the math. A new roof might cost $15,000, but it could drop your insurance premium by $2,000 a year. Over just 7 years, that roof pays for itself, and you still have 8+ years of savings after that. Plus, newer roofs qualify for the best mitigation credits. If you have the cash, a new roof is one of the best financial investments you can make in this insurance market. There's a lot of moving parts here. New carriers, expiring inspections, depopulation letters. You need to know which of these 83 companies filing for rate cuts are actually safe and which ones are just cheap. I've compiled a 2026 Florida insurance report card. It lists the major carriers and their WICE safety rating, which is much tougher than the standard Demotech rating everyone uses. I also included the claim denial rates for 2024 so you can see who actually pays out when a storm hits. Click the link in the description or scan the QR code on the screen to download that report card for free. And if this feels overwhelming, I've also linked to independent insurance agents I trust in the description. Sometimes you need a professional in your corner to navigate this stuff. But here's the bottom line. Don't just auto-renew this year. The market has changed. The rules have changed. Remember that announcement from the governor's office? The headline said, rates are dropping. And they are, but only for people who know where to look, what to avoid, and how to position themselves. Everyone else, they're paying for the recovery. Take out your policy right now. Audit it against the list. Check your wind mitigation inspection report. Look under your sink. Make sure you aren't the one subsidizing everyone else's savings. Hey, I'm Tom McNamara, the Florida Real Estate Insider. Stay dry, read the fine print, and I'll see you in the next one.